Most traders spend their nights staring at charts, searching for that one pattern that will finally make sense of the market. They chase candlesticks, waiting for magic in the form of green and red bars. But what if I told you the real trading signals are not inside the chart, but beyond it? If you're tired of false signals, fake patterns, and endless confusion, then stay with me till the end. Because in this talk, I'll reveal how to decode trading signals in a way most traders never even think about. And before we dive in, make sure to subscribe to Whispers of Psychology, because here, we don't just talk about trading. We explore the psychology, discipline, and mindset that turns average traders into masters of the market. When most beginners step into trading, they come with one assumption, that the truth of the market lies in the patterns. They believe that if they just memorize enough candlestick names, study enough chart formations, and master enough technical indicators, they will unlock the secret to success. And while patterns and charts do matter, the harsh reality is this. Signals are not just patterns. They are not magical codes drawn by the market to reward whoever studies them longest. Think of it this way. A candlestick is nothing more than a reflection of what happened in a specific time frame. It tells you where price opened, where it closed, and the highs and lows in between. That's it. But does that tell you why it happened? Does it reveal the psychology behind the move? Does it explain what traders were thinking in those moments? No. And that's where most traders get trapped. They confuse the symptom with the cause. The candlestick is the symptom. The real signal lies in the cause. Behind every chart are millions of decisions being made by traders around the world. Some are retail traders acting on emotion. Others are institutions moving billions with precision. Together, they create the flow we see on our screens. So, when you see a bullish candle forming, it's not the candle that matters. It's a collective psychology of fear and greed, optimism and doubt that push prices to form that candle. If you only look at the surface, you will forever be at the mercy of false breakouts and misleading signals. A signal becomes meaningful only when you connect it to context. Let me give you an example. Imagine you see a strong bullish engulfing candle on your chart. Most textbooks will tell you this is a reversal signal. But is it really? If that candle forms in the middle of a strong downtrend, with no increase in volume and no shift in sentiment, chances are it's just noise. Traders who blindly trust a pattern jump in, only to get trapped. But a trader who looks beyond the chart asks, what's happening in the bigger picture? Is the market reacting to news? Is volume supporting the move? Is the trend weakening? That trader isn't reading the candle. He's reading the story behind it. This is why signals are not just patterns. They are interpretations of human behavior expressed through price. Every wick, every body, every spike in volume represents the emotions of people like you and me, except multiplied by millions. Fear creates panic selling. Greed creates impulsive buying. Uncertainty creates choppy ranges. If you want to decode trading signals, you need to decode psychology. Another trap is over-reliance on indicators. Traders load their screens with moving averages, oscillators, and colorful tools, believing that when three indicators align, they've found a golden signal. But the truth is, indicators are still derivatives of price. They lag. They don't predict. They summarize. A moving average cross might look like a signal, but if you don't understand the market sentiment behind that move, you're still trading blind. Real traders learn to strip away the noise. They use charts not as fortune-telling tools, but as mirrors of human behavior. They recognize that a candlestick is just the tip of the iceberg, and the real signal is buried beneath it. In trader psychology, in market sentiment, in the flow of volume. This is why some traders can look at the exact same chart as everyone else, yet interpret it differently and come out profitable. They are not trapped by the illusion of patterns. They see the deeper story. Think of it like reading a book. If you only look at the letters, you'll never understand the meaning. You have to connect words, sentences, emotions. Similarly, in trading, if you only look at individual candles, you're reading letters, not the story. The story is where the real signal lives. Now here's the uncomfortable truth. Most traders don't want to hear this. They want shortcuts. They want a signal they can copy and paste, something they can follow without thinking. But the market punishes that mindset, because the market is not mechanical, It's psychological. And unless you embrace that truth, you will forever misread signals. The traders who succeed are the ones who ask deeper questions. Instead of asking, what does this candle mean? They ask, why did it form? Who is behind it? What emotion is driving this move? Those are the questions that separate chart watchers from real traders. So, when you see a candlestick tomorrow, don't just ask if it's bullish or bearish. Ask what story it's telling. Ask what fear or greed lies behind it. Because once you start decoding signals in this way, you stop being fooled by noise, and you start seeing the market for what it truly is, a living reflection of human psychology. And that is the first step to trading beyond charts and candlesticks. But let me ask you a powerful question. If charts and candlesticks alone were enough to decode signals, then why do traders who see the same patterns end up with completely different results? Think about it. Two traders can look at the exact same chart. One sees an opportunity and profits, while the other loses everything. If the signal was truly in the chart, wouldn't both traders come to the same conclusion? This paradox reveals something deeper. The truth is that signals are not formed by lines, shapes, or candles alone. They are born from market psychology. Behind every movement in price, there are emotions boiling under the surface. Fear, greed, hope, and panic are the real architects of the market, and charts are nothing more than their shadows. When the market rallies, it's rarely just a green candle pushing higher. It's optimism spreading across traders' minds, convincing them that prices will continue to climb. When the market crashes, it's not only a red candle forming on the screen. It's fear, spreading like wildfire, forcing traders to sell even when logic says to hold. The candlestick is just the body. The psychology behind it is the soul. And without understanding the soul, you'll always misinterpret the body. Consider the moment when price suddenly spikes upward. A beginner may see it as a breakout and rush in. But what if that spike was just a short squeeze, driven by fear among those who are shorting the market? The signal is not the candle itself. It's the psychology of shorts panicking and covering their positions. Unless you recognize that, you mistake desperation for strength. This is how traders get trapped, not because the pattern lied, but because they ignore the emotion behind it. Market psychology also explains why patterns repeat, yet outcomes differ. A head and shoulders formation is considered bearish. Yet sometimes after forming, the market doesn't fall. It rises. Why? Because patterns are only probabilities, and probabilities are influenced by the mood of the crowd at that moment. If the majority of traders distrust a formation and bet against it, their collective action can flip the expected outcome. This is why relying on patterns without psychology is like reading words without understanding the language. Think of crowd behavior. Imagine a stadium full of fans. When one group starts chanting, others join in until the entire stadium erupts in the same rhythm. That's how markets work. A few large players take action, sentiment shifts, and suddenly the whole crowd follows. The candlestick you see is the echo of that chant. To decode signals properly, you must learn to hear the chant before it becomes visible on the screen. This is where the concept of herd mentality becomes crucial. Traders often move not because of their own analysis, but because they see others moving. News spreads, rumors ignite, and soon everyone is rushing in the same direction. If you only look at the chart, you see a line moving. But if you study psychology, you see the herd being driven by emotion. And when you understand the herd, you can anticipate the move before the chart confirms it. Institutional traders exploit this every day. They understand that retail traders react emotionally to signals. They know fear causes premature selling, and greed triggers reckless buying. So they create traps, false breakouts, manipulated moves that play directly on psychology. Retail traders who rely only on candlesticks fall into these traps again and again. But those who recognize the psychology behind the move avoid being victims. They don't ask, what does this candle mean? They ask, who created this candle and why? Now let's revisit the question I asked earlier. If two traders see the same chart, why do they end up with different results? The answer lies here. One trader reads only the pattern. The other reads the psychology behind the pattern. One trades a shadow. The other trades a substance. The market rewards a trader who sees the unseen, the emotions driving the crowd. The truth is, you will never fully decode trading signals until you understand that charts are only the surface. Beneath them is a river of human behavior. Fear of missing out, panic, greed, hesitation, and doubt. That river is invisible to most, but it is the true source of every signal. If you learn to read it, patterns stop being random, and signals start making sense. Because in the end, it is not the chart that moves the market. It is the mind, the crowd. And when you understand the crowd, you finally understand the signal. And this brings us to another truth that separates amateurs from professionals. One signal alone is weak. A single candlestick, a single indicator, or even a single piece of news is never enough to guide a serious decision. Real trading signals are built on confluence, not on isolated confirmation. In other words, the more factors that align, the stronger the signal becomes. Imagine trying to judge the strength of a bridge by looking at just one piece of steel. On its own, that piece tells you nothing about the entire structure. But when you examine the whole foundation, the supports, the engineering, and the weight it can handle, then you can decide if the bridge is safe. Trading works the same way. One candle is just one piece of steel. The real strength comes when you see the foundation around it, the trend, the volume, the sentiment, and the broader market context. For example, let's say you spot a bullish engulfing candle. By itself, it looks promising, but you don't stop there. You check the volume and see it's unusually high, showing strong participation. You check the trend and realize the market had been consolidating for weeks, building pressure. You look at market sentiment and notice traders have been overly bearish, creating the potential for a sharp reversal. Now, suddenly, that single candle is not just a pattern. It's part of a story with multiple confirmations. That's confluence, and that's what gives a signal real meaning. Without confluence, traders fall into the trap of false signals. How many times have we seen a breakout on the chart, only for the market to reverse immediately? That happens because traders jump in on a single sign without asking whether other factors agree. A breakout with no volume is like a shout in an empty room. It makes noise but carries no weight. A divergence on an indicator without price confirmation is just static, not music. The market constantly throws noise at you, and your job as a trader is to separate that noise from genuine signals. Confluence is the filter that does exactly that. Another layer of confluence comes from understanding time frames. A candlestick pattern on the 1-minute chart might look powerful, but if the 4-hour chart shows the opposite trend, the smaller signal is likely to fail. Professional traders align signals across multiple time frames. They look for agreement between the short-term action and the long-term structure. This is like zooming out a puzzle. One piece might look confusing up close, but when you see how it fits into the bigger picture, it suddenly makes sense. Confluence also teaches you patience. Many traders rush into the market because they see one signal and don't want to miss out. But a professional knows that waiting for multiple signals to align is what separates gambling from strategy. Confluence doesn't just give you better entries. It gives you confidence. When volume, price action, sentiment, and trend all point in the same direction, you no longer feel like you're guessing. You feel like you're making a decision supported by evidence. This is why confluence is more powerful than confirmation. Confirmation often means waiting for one factor to support your initial bias. For example, you believe the market is going up, so you look for a candle that supports your belief, and when you find it, you jump in. That's not real analysis. That's bias seeking validation. Confluence, on the other hand, demands that you step back and ask, are multiple, independent factors all telling the same story? If they are, you have a signal worth trusting. If they're not, you stay out. And in trading, the trades you avoid are often more important than the trades you take. The beauty of confluence is that it doesn't eliminate uncertainty. It manages it. Because let's be honest, no signal, no matter how strong, is ever a guarantee. The market is unpredictable, and surprises can always happen. But confluence shifts the probabilities in your favor. And in trading, that's all you need, not certainty, but probability. Every decision you make is about stacking odds on your side, and the more confluence you have, the more stacked those odds become. At the same time, Confluence doesn't mean clutter. Many traders confuse multiple signals with more indicators. They crowd their screens with 20 tools and wait until all of them align. But that only creates paralysis. Confluence is not about quantity, it's about quality. A clean chart with 3 strong factors aligned is worth more than a messy chart with 20 weak signals. The art of trading lies in simplicity, knowing which signals matter most, and then waiting for them to come together. So when you decode trading signals, don't look for a single pattern to save you. Look for the bigger story. Ask if the candle matches the trend, if the volume confirms a move, if the sentiment supports the price, and if the broader market agrees. When multiple voices say the same thing, the market is no longer whispering. It's shouting. And those are the signals worth listening to. And this leads us to perhaps the most important truth about trading signals. They are not about predicting the future. They are about preparing for it. Many traders enter the market with the wrong mindset. They want certainty. They want a signal that guarantees success, a pattern that assures profit. But the market doesn't reward certainty. It rewards discipline. When you approach signals as a way to predict, you place yourself in a position of weakness. Because the moment the market doesn't behave as you expected, you feel betrayed. You panic, you overreact, and you abandon your plan. But when you approach signals as probabilities, when you see them as guides, not guarantees, you shift into a position of strength. Now, instead of asking, will this trade win, you ask, if this setup plays out, am I prepared? If it fails, am I protected? That shift in mindset changes everything. Discipline is what turns signals into strategy. Anyone can spot a candlestick or draw a trend line, but very few have the patience to wait for their setup, the control to size their trades properly, and the courage to walk away when conditions aren't right. Discipline is what transforms a chart from noise into opportunity. Without it, even the strongest signal becomes useless. Consider 2 traders who both spot the same confluence signal, a breakout supported by volume and sentiment. The first trader is disciplined. He waits for confirmation, sizes his position wisely, and sets a stop loss in case the market reverses. The second trader is impulsive. He jumps in too early, risks too much, and doesn't have a clear exit plan. The signal was the same, but the outcomes will be worlds apart. The disciplined trader sees the signal as probability. The impulsive trader sees it as prediction. One survives, the other sinks. This is why successful traders often sound more like philosophers than gamblers. They know that markets are uncertain and they accept it. They don't fight the uncertainty. They adapt to it. They trade with the mindset of the Stoic, calm in the face of chaos, detached from the outcome, focused only on what they can control. A Stoic trader doesn't need the market to obey his prediction. He only needs to obey his own discipline. And here's the irony. When you stop trying to predict, you actually start to see more clearly. The pressure of being right disappears. You no longer force the chart to tell you what you want to hear. Instead, you listen to what it's actually saying. You trade with objectivity. You accept losses as part of the game, and you protect yourself against them. You ride your winners with patience, knowing that even if not every trade works, your discipline ensures you'll win in the long run. Preparation also means building resilience. No trader avoids losses entirely. Even the best signals fail. But a disciplined trader survives because he plans for failure before it happens. His stop loss is not an afterthought. It's a rule. His risk management is not optional. It's mandatory. He doesn't ask, what if this trade fails? Because he already knows the answer. He'll move on, preserve capital, and wait for the next opportunity. That mindset is what allows him to stay in the game long enough to succeed. Signals, then, are not about certainty. They are about stacking probabilities in your favor, while protecting yourself against the times when you're wrong. And this is where the real edge lies. Not in knowing the future, but in managing the present with discipline. When you hear traders talk about intuition or instinct, what they really mean is this. After years of disciplined observation, they have trained their minds to recognize probabilities without forcing predictions. They don't feel the need to win every trade. They only need to follow their plan consistently. The market rewards that mindset because the market is a game of survival. Those who chase predictions burn out quickly. Those who master discipline endure. So when you decode trading signals, don't ask for certainty. Ask for clarity. Don't look for guarantees. Look for preparation. Your job is not to outguess the market. It's to align yourself with it, to read the story it's telling, and to act with discipline no matter what the outcome. Because in the end, trading is not about being right. It's about being consistent. It's not about predicting the next candle. It's about preparing for the next move. And when you embrace that truth, you step into the mindset of a real trader. A trader who doesn't cling to patterns for comfort, but who uses discipline to navigate uncertainty. A trader who understands that signals are not prophecies, but probabilities. And that is the ultimate truth beyond charts and candlesticks. So, when you step back and look at everything we've uncovered, one truth becomes clear. Trading signals were never just about charts and candlesticks. They were never about memorizing patterns or predicting the future with certainty. They were always about understanding the deeper forces at play, the psychology of the crowd, the power of confluence, and the discipline to treat signals as probabilities rather than promises. The market doesn't reward those who chase shortcuts. It rewards those who see beyond the obvious, who remain calm when others panic, who stay disciplined when others lose control. If you can learn to read the story behind the signals, align multiple factors into one clear voice, and act with patience and discipline, then you're no longer just reacting to the market, you're decoding it. And that is the real edge. Not prediction, but preparation. Not perfection, but consistency. That's how you survive, and that's how you thrive. If this message resonates with you, then don't let it end here. Take the lessons from the day, apply them in your own trading, and start seeing the market with new eyes. And if you want more insights like this, where trading meets psychology and discipline meets strategy, make sure to subscribe to Whispers of Psychology. Share this with a fellow trader who needs to hear it. And let's build a community of thinkers, not gamblers. Because charts may show you price, but psychology reveals the truth. And once you learn to see beyond candlesticks, you'll never look at the market the same way again.